Hello, welcome back. Mike from Canavan Wealth. It is Tuesday, July 25th. Time for Mike Reads the Journal. Markets are up. This is record setting. If we end up today, which is not any guarantee because it's still fairly early, this will be the 12th straight day, I believe, in the Dow gaining. Now, the S&P hasn't had 12 straight days, nor the NASDAQ, but the Dow specifically has been doing very well, which is usually a good sign for the markets. I often tell folks that in kind of what we have seen over the last, I don't know, let's say 15 investment years is that when growth stocks do well, value stocks will typically lag, typically not do quite as well. And although the Dow is not a value stock index, I often kind of use it as a gauge of how value stocks are doing. We saw that through the downturn, the previous year, in which we saw really great growth out of like the tech industry in 2021, and then when the 2022 downturn came, the value stocks really stayed level where growth went down, and now we're seeing growth take off for the majority of the first half of the year, and now kind of the rest of the markets are starting to catch up. That is usually a very healthy sign for the markets. Now, that doesn't mean that I don't think we're going to go through a little bit of a downturn here at some point because we've done so stinking well in July. Just over the last month percentage, we're up 5.3. Last 5 days, we're only up about 0.2, 0.27. Year to date, getting close to 19, 18.82. Pretty amazing year. Obviously, we're still not back to where we were in terms of the highs, but it's not going to be that long. Right, we are, that's where we were, still not too far off. Now, whether we level off, see a little drop before the end of the year, only time will tell. All right, I love talking about interest rates and inflation. So this is specifically an article that kind of targets Britain, specifically around the fact that much of their debt is tied to inflation-linked securities, meaning the interest on the debt, like a TIPS here in America and inflation protected, is tied to inflation. So inflation is high, their debt becomes more expensive, which is kind of this double whammy. Kind of got themselves in a pickle here because of it. They're still really not, I don't feel, in a really, really dangerous place, but this affects everyone. Not only the fact that some debt is tied to inflation, including here in the US, but that when interest rates go up and stay up, it dramatically affects a country's ability to pay its debt, right? So when, for like the last 14 years, when interest rates were almost nothing, debt is not that expensive, because when you're paying 0.5% or 1% on something, and then that goes to 4%, it becomes substantially more expensive. Effectively, your debt becomes 4 times. It's like getting 4 times as much base debt because you have to pay that much more on it. Now, that's not all happening. As soon as interest rates don't go up, it's not like all of a country's debt now comes to the new interest rate, but certainly any new debt you take on and any debt that's maturing during that time and that you're going to have to roll over to a new fund. So this is here one of the things I want to talk about. So the benchmark for 10-year fixed interest rate bonds, 4.3 for the UK, 4% in the US. Both were below 1% before the pandemic. So cost of debt has gone up 4 times. This is one of the reasons, right, the Fed wants, and the US government wants to get interest rates and inflation back down low, is because it affects our ability to pay our debt, which I've done videos on the debt. I'm not an alarmist over the debt. However, it is something that we have to address. And, if you want to read through this article, it's very good. I'm not going to go over everything in it. It's really kind of putting a big finger wag on the UK in terms of how much inflation-linked debt that they had. All right, switching over to Russia. This is really about what's kind of similar news and what's going on in the Russian economy, specifically around their interest rates. I found this graph really interesting. So this is effectively Russia's Fed funds rate, their equivalent, that back before the Ukraine war was about 8.5. They raised it up to 20% right in the beginning, and then we're able to bring it back down and keep it around 7.5%, but they've just started to raise it again. Now, this is not a very good trend, and I don't think this is the big takeaway from the article, which is like Russia raised their interest rate 1% when they were only expecting 0.5% or something like that. this is about everything else that's going on, specifically around in the beginning of the war, because gas prices went as high, they were largely able to kind of deaden the blow of sanctions and things like that based on how economically favorable selling their oil was. And that has largely changed. You see the change in the Russian ruble really tanking, especially after the kind of failed coup, whatever you want to call it, that went on with the Wagner Group. They talk about the labor market, right? So there aren't enough workers, wages are soaring, inflation is looking like it could get really, really bad. So, the war's impact now a year out is really starting to show the long-term effects on the Russian economy that is going to probably continue to squeeze them. So, not any surprise, but this is kind of coming a little later than I think Western countries would have expected. They kind of hoped that these economic sanctions would really put a squeeze on Russia and Putin faster than it did. It looks like it's finally arriving. We will see the kind of long-term part of this. I could not help but cover this. Before I say anything on this, I will say that this is something that I don't understand anything about, and thus anything I'm going to say is going to be relatively uneducated. But this is about this article. I'll provide the link to it. Is about families paying for these sorority consultants so that their daughters can get into, I guess, very selective sororities. This is specifically an article about University of Georgia, these kind of big state universities in the South. While I understand, I guess the selection rates on these are crazy low, and all these young women want to get into them. I'm not entirely sure how I feel about this. I'm always interested in these kind of niche industries. And I have no doubt that for young women who want to join what I view as a social club, or just one of any number of social clubs that are consistently rejected, largely just due to the numbers game, that would be very demoralizing. I guess my thoughts are just that maybe we should be looking at why we want to join them at all. But I am not a young Southern female trying to join a sorority, so I'm not going to try and pass too harsh of a judgment on them. And this kind of rang true to me. This is a mom saying, when her daughter keeps calling, very upset that she's not getting into sororities. How could they not want my kid? And thus she calls one of these consultants. And as a parent who has two kids going away to college, I don't believe neither of them will be joining Greek life. I do, however, feel this mother's pain. Certainly no one wants to think that, their daughter, their son, whoever it is undesirable in any type of a social situation. So, interesting industry. I do not want to cast too much blame or judgment on anyone here. It sounds like some of these consultants do great work, but I think the system as a whole kind of troubles me. That's really it. I think we have some news coming out of the Fed here in a little bit in terms of interest rate hikes and notes, and that will be very telling for the rest of the year. I think everyone kind of understands we're going to continue to see an interest rate hikes, maybe 2 more 0.25%. It's really going to be the tone of the Fed, and I'd love to know what their thoughts are on the recent craziness in the market, specifically with how high the market has been going in the face of this. Powell, it has always just seemed to me like doesn't like it when the market does well based on what they think interest rate and inflations are going to do. And he usually likes to bring people back to reality with his comments, which is often not very good for the markets. But we'll just have to see. I will talk to you soon. Thanks.